to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris, and I teach trading at Trading University. First market we'll take a look at will be the Australian US dollar. I've gone ahead and put my risk tolerance threshold ratio right on the chart there. That makes it easier for me to analyze these markets. What pops out at me is you stopped right at that 25-day resistance right there. The ratio, what that means is, what the ratio does is it basically collates the different patterns in the market. That's how we decide whether we're going to be a buyer or a seller. I'm most familiar with trading these lower time frames. However, there's no doubt about it, just as in technical analysis, the higher time frames do tend to be pretty influential. Right now, from a shorter term trader's perspective in the Aussie, we'd be buying dips. However, when you look intermediate, longer term, that pattern is still down for now. So very interesting. You knocked your head right on that 25-day pattern line there, that two-third retracement right there. So it'd be hard to get excited about this guy from an intermediate to longer term trader's perspective, more from an investor's standpoint, as long as you're still below that level right there. Next market we'll take a look at will be the dollar Swiss. There's our ratio there. Dollar Swiss for us still a pretty bullish chart overall. You could see that 25 and 50-day pattern. They're still bullish. There they are. There's your 50-day pattern line. You're still above there, and there's your 25-day. So as long as you're above those green lines, you're still bullish on this guy. Essentially what it means, if you want to trade the market short term, that's fine because you have your 5 and 10 are down. On the other hand, from an investor standpoint or from a swing trader standpoint, you kind of limit it downside, right? So you have support either side of 94. Even on the other hand, from a historic perspective, pop out to a monthly chart. There it is. You have a whole lot more room on the upside from our perspective than on the downside. So back down to the daily chart, from our perspective as swing traders, investors, we're definitely more interested in buying dips in this guy than going after the short side. Here's the dollar index. Here's another guy where you definitely have conflict. You're definitely in a counter trending market in that your lower time frame patterns, the day trade patterns, are down. On the other hand, that 25-day pattern still holding, still up. There it is. You can see it right there, that green line. So they didn't do much technical damage at all, really, other than those shorter term patterns as far as the Fed not making a move this time around. Fed's been very cautious all along. I'm sure they'd like to see stronger growth. Yes, you had an uptick in retail sales. On the other hand, it was a pretty small one. So, you know, the U.S. economy, it's not quite where they want it to be. I don't even think you could call it a Goldilocks because it's just a little slower than they'd like. On the other hand, it is growing. You're seeing month to month, those retail sales are growing. In fact, that was the biggest retail sales number we've ever seen, to put that in perspective. On the other hand, it's not as quick as they'd like it to be, or from the Fed's view, it's slower than they'd really like to see it. Back to the dollar index here, it's another one from a historic perspective, or at least longer term perspective. We see this market as having limited downside. From a swing trader or investor standpoint, not a lot of room down below. On the other hand, from a historic perspective, pop out to that long-term monthly chart, and you can see for sure you got a lot more upside to it than you would the short-term downside. Next market, euro. Here's your daily euro chart. Both as a short-term trader and an intermediate-term trader, more of a swing trader, you'd definitely be interested on the upside here. Buying dips, it has worked pretty well for us. As I said before, I'm more familiar with these lower time frames, trading the 25, 10, and the 5. Basically, I take those three successive time frames, the 5, 10, and the 25, and I just trade whatever way the majority of patterns is going with, right? So if I have 2 out of 3 patterns going in one direction, that's the direction I'm going with, and really, and that's how I've been approaching the euro. From our perspective, the short term, very profitable. That's when we show our benchmark, the numbers we put up. I should say the numbers our trading method puts up as far as the trades, where you can see going back to year beginning, and you just see steady growth all along the way. that's all based on trading in the direction that these three lower time frame patterns tell us to trade in. The advantage of the lower time frames is you have a bigger sample size. You get up into those higher time frames, you're not going to have as big of sample size. From our perspective, we're seeing self-similar behavior regardless of the time frame tested, regardless of the pattern tested. So that's interesting. But getting away from that from an academic standpoint and getting right back to forecasting markets, similar story. You're essentially counter trending that the long term, the primary is still down. On the other hand, secondary up. Very short term. My lower time frames here are telling us to continue to buy dips. So not a lot of direction here yet. However, from a historic perspective, from a long-term perspective, pop it on out to a monthly chart, and we still see the momentum is being down here, no doubt about it, and we still see this as being a very shallow correction, and really because of that, you still have to consider that the market's pretty weak. If it was stronger, it certainly would have given you a larger retracement than the one you've seen to date. Next market, the gold market. As we said last week, gold kind of weak. You're finally coming to life now in sympathy with that weaker dollar, but you're still below very definite resistant levels. Here you see this 2/3 retracement of that 25-day pattern. So 25-day pattern down, you're still below the 2/3 on that. We see this as very definitely an interesting area on the chart, both from a swing trader intermediate term standpoint to possibly a long-term standpoint too. So that's definitely going to be an area to watch overall. We see weak gold as a leading indicator for overall dollar strength, overall global economic strength. It doesn't always seem like it when you see those week-to-week numbers, but overall the trend is in place for steady growth in the U.S. economy, and you're seeing a pickup in Europe, etc. also. Last market we'll cover, U.S. interest rates, the U.S. 10-year rate. Here's 10-year interest rates, a daily chart in the U.S. Again, you have conflicting story here. The secondary pattern overall is up. On the other hand, you're mixed up there. Well, your secondary and 25-day pattern are both up. Those are powerful patterns. On the other hand, short term, you're lower here. But overall, I want you to note the pattern of higher lows, very significant right there. So U.S. interest rates are still telling us that overall that trend is for higher rates in the United States. And as we've said in the past, overall, and as we've said in the past, even if the U.S. holds that slow growth rate track that it's on, it's not a matter of if, but a matter of when the U.S. is going to raise interest rates. And I think I have to admit they've probably done a pretty good job. They're trying to avoid any kind of shock to the markets, especially that you've had weakness in China, weakness in the Far East overall, Australia overall. So I think it was probably prudent, probably wise of Madam Yellen to hold off on any rate rise in that environment. Let's give these markets, particularly in the Far East, a chance to try to carve out some support and maybe reverse that bearish momentum before you give them any kind of shock treatment that a rate hike in the States would probably spell. My name is Jay Norris. I teach trading at Trading University, and we'll see you again next week.